You are trading actively in the marketplace, but are you genuinely winning consistently over time? Many individuals engage in speculative activities without ever realizing meaningful or sustainable success. True lasting profits are derived from systematic, patient execution of proven strategies exclusively. You must critically and honestly assess your current trading performance before proceeding further. Most novice traders fail disastrously because they consistently risk far too much capital too early in the trade. They often mistakenly confuse simple market volatility or random luck with genuine skill and confirmed conviction. Over-leveraging small initial positions instantly destroys necessary discipline and exposes you to ruinous risk unnecessarily. Never put yourself in a compromised position where one singular mistake costs you everything important. The journey of a speculator is often a solitary one, marked by the intense pressure of making high-stakes decisions alone. It is easy to lose perspective, to be swayed by the noise of the crowd, or to falter in your discipline after a series of setbacks. This is why we created this channel, to serve as a constant source of these timeless principles, a place you can return to, not just to learn, but to recalibrate your mindset. If you are committed to the path of a professional speculator, subscribe to our channel and return to these lessons. They are here to provide not just knowledge, but reinforcement and perspective when you need it most. The true secret to accumulating massive generational wealth is intelligent, deliberate position building, not instant, aggressive market entry. You must approach the entire market environment as a slow, deliberate opportunity, not a desperate, high-stakes gamble. Position building minimizes your overall risk profile while simultaneously maximizing exposure to strongly confirmed major trends. Understand that the market always rewards precise patience over impulsive action every single time. You must learn and flawlessly execute the precise Livermore method if you genuinely wish to dominate significant market trends systematically. This comprehensive strategy is time-tested and firmly built upon meticulous observation and mathematical probabilities of success. It completely removes the destructive element of emotional decision-making from the complex trading equation. Adopt this rigorous method immediately to ensure your valuable capital is always protected and working efficiently for you. This specific 5-step system is strategically designed to build massive positions safely and incrementally over time. It absolutely ensures that the market confirms your initial directional idea before you commit substantial, significant capital reserves. You are only permitted to scale into real size when the trend is already vigorously generating substantial paper profit for your account. You must follow these detailed steps meticulously to successfully avoid massive and unnecessary risk exposure. Stop acting like a reckless gambler seeking cheap, instant thrills within the complex financial marketplace. You must trade strictly based purely on indisputable market evidence and confirmed, verifiable price action movements. Gambling assumes randomness dominates, but true speculative trading recognizes observable, repeating patterns and clear directional flow. Let the physical ticker tape be your only guide, ignoring all outside opinions, forecasts, and distracting noise completely. Emotion is undeniably the single greatest destroyer of trading capital known to every man who dares to speculate. Greed and fear inevitably distort objective perception and consistently lead to catastrophic, irreversible errors in judgment and execution. Discipline is, therefore, your greatest and most necessary asset in this highly volatile and unforgiving business endeavor. You must maintain an almost mechanical, robotic adherence to your established set of trading rules, always and without fail. Correct, precise market timing is truly everything when pursuing exceptionally large, profitable objectives in speculation. Entering a position too early forces you to endure unnecessary periods of volatility and damaging capital drawdown risk. Patience is the rare, critical virtue that consistently earns the vast fortune in volatile speculative markets over the long term. Wait for the precise moment the market itself gives you undeniable permission to fully proceed with confidence. Never, under any circumstances, attempt to chase market prices that have already moved significantly past your initial analysis entry point. Let the current market action fully prove its trajectory and conviction before you ever commit your precious limited capital. Chasing prices usually means entering immediately at the peak of the prevailing movement, setting yourself up for inevitable failure. A missed opportunity is always infinitely better than forcing a premature resulting loss. You must develop an extremely deep and highly intuitive understanding of volume and price action working together in perfect synergy. Volume is the only factor that confirms the genuine conviction behind any price move, instantly verifying its fundamental integrity. Learn to read the tape flawlessly to understand the true underlying forces immediately driving the asset's movement. This critical skill successfully differentiates genuine speculators from mere amateur guessers in every instance. The absolute first rule of effective intelligent speculation is to clearly identify the undeniable path of least resistance immediately. Determine whether the concentrated force of buying or the sustained force of selling is currently dominating the overall market flow. Trading in opposition to the established dominant trend guarantees a rapid and financially ruinous result quickly. Focus only on capturing movement along the clearest, most obvious path provided freely by the market. You must constantly and rigorously ask yourself whether the market is currently trending strongly up or trending forcefully down with conviction. Look intently for sustained directional movement that is consistently backed by high, confirming volume signatures and velocity. Avoid all market conditions where the price is chopping aimlessly sideways without establishing a definite, clear direction. Clear, confirmed trends offer the highest probability and largest potential returns consistently. Ignoring this basic, fundamental truth about the market's path of least resistance guarantees the execution of massive and quick capital losses. If you stubbornly try to pick definite tops in a strong bull market, you will be relentlessly crushed by market momentum. Conversely, attempting to buy premature dips in a confirmed bear market systematically destroys working capital reserves. Respect the prevailing trend until the market conclusively proves that the direction has genuinely and fundamentally reversed completely. Use established, verifiable pivot points specifically to confirm when major, significant directional changes are truly occurring in the underlying asset. These critical points act as necessary markers where market momentum shifts from systematic accumulation to aggressive distribution, or the reverse. A clear break and sustained movement beyond a confirmed pivot point signals the precise time for serious entry action. Never trust mere reversal indicators, unless they are solidly confirmed by significant price velocity at these key pivots. Wait patiently for absolute, undeniable clarity before initiating any speculative position whatsoever in any asset. Never allow internal psychological factors like boredom or gnawing impatience to force a premature position entry upon your portfolio. The vast market will invariably offer fresh, lucrative opportunities to disciplined, patient observers who simply wait calmly. Your patience acts as a crucial filtering mechanism, successfully saving you from countless unprofitable, random movements. Your first block of shares must serve exclusively as a very small initial testing position designed purely for market verification. This incredibly small block acts as your reconnaissance unit, carefully probing the immediate market conditions before full capital deployment. This small size allows you to fully verify your directional thesis without exposing significant capital immediately to danger. Always remember that the first commitment is purely experimental, never definitive or final. This small initial pilot trade is designed purely to confirm your directional analysis hypothesis instantly and without delay. If your hypothesis is genuinely correct, the market will immediately begin moving in your anticipated direction quickly and consistently. The primary purpose of this initial test is not instant profit, but rather validated conviction regarding the trend's immediate existing strength. Treat this initial entry as a necessary controlled risk taken solely to gain verified information about the flow. If the market immediately moves against this tiny initial block, the resulting financial loss must be entirely minimal and easily insignificant to your capital. Accept this small, calculated loss immediately and swiftly, recognizing that the market has just proven your timing flawed. Do not hesitate for even a second. Exit the unsuccessful position instantly and preserve your remaining available capital. Learn to value capital preservation above the psychological necessity of always being perfectly correct in your market analysis. The market itself always tells you precisely and instantly when you are genuinely right about the prevailing forces at play. A quickly profitable initial position signals that your timing aligns perfectly with the established current trend flow. When the price begins moving quickly and effortlessly in your favor, the evidence is compelling and absolutely undeniable for continued commitment. This positive feedback loop is the official green light for controlled, systematic expansion of your overall position size. Never, ever, under any circumstances, allow yourself to add fresh capital to a currently existing losing trade position. Doubling down on an established mistake is the predictable hallmark of the typical amateur speculator who blindly hopes for recovery. A losing trade proves your initial assessment or timing was fundamentally flawed, demanding immediate, decisive exit instead of reinforcement. Preserve your essential mental capital and cash reserves by strictly refusing to reinforce a definitively failed speculative position. If your small first block immediately begins to profit substantially, the major trend is confirming your underlying view perfectly and without flaw. This initial success provides the necessary foundation and crucial psychological confidence required for executing the next phase of scaling up. You have now successfully established a risk-free position, utilizing only market capital derived from paper profit, not your own cash reserves. The market is now formally inviting you to commit further capital with a significantly higher probability of success. Now that the critical first test has successfully passed all scrutiny, you may safely proceed to add your second, slightly larger position block. This subsequent block represents a highly calculated increase in exposure, strongly supported by your accrued initial paper profit buffer. Ensure the market shows sustained, increased strength and velocity before initiating this subsequent entry into the trade. Confidence must always be derived strictly from the ticker tape's favorable movements, nothing else externally. Ensure that this vital second addition to the trade is made only upon the confirmation of significant, distinct new highs in an advancing trend. Never add capital when the price pulls back. Scale up only when the asset clearly demonstrates renewed bullish conviction and momentum. Waiting for the confirmed breakout guarantees that you are trading in perfect alignment with accelerating market momentum completely. This strict rule prevents you from adding capital during temporary, unconfirmed dips or inevitable minor volatility. You must scale up your existing position size only when you are already sitting upon a substantial, highly comfortable cushion of paper profit. This established profit acts as an essential protective shield against inevitable market fluctuations, minor pullbacks, and sudden reversals. Never commit a larger sum of capital until the preceding, smaller commitment has proven its immediate merit convincingly with confirmed profits. Profit protection remains the key guiding principle governing all forms of intelligent position expansion strategies. Your established existing paper profit now effectively acts as a buffer to protect any subsequent new capital additions you introduce into the trade. If the market suddenly reverses its direction, the potential loss is first entirely absorbed by the profits already accrued in the initial blocks. Use this powerful mathematical advantage strategically to reduce your overall margin risk exposure immediately upon expansion. This strategy fundamentally allows you to think like a wealthy strategic businessman rather than a desperate panicking gambler. The true immense power of this system resides in adding the typically largest block incrementally and safely during the trend's acceleration phases. This final phase strategically captures the core, decisive movement of the major trend with the maximum possible exposure. You have definitively earned the right to deploy serious capital by successfully following the market evidence step by step and without deviation. Remember always, patience in the entry phase consistently builds a resilient, profitable position base overall. This final, typically largest block of shares is scaled in precisely when the market trend accelerates strongly past confirmed pivotal resistance points. Look intensely for explosive price movement and sustained institutional interest confirming widespread conviction in the established direction. This is the precise moment to capitalize decisively on the momentum you correctly anticipated earlier in the process. Never hesitate when the market offers such powerful, undeniable, and clear confirmation of your initial thesis. It remains absolutely imperative that your overall average cost for the entire position always remains far below the current prevailing market price. This required spread ensures you maintain a substantial protective buffer against minor volatility and any unexpected news events affecting the asset. If your average cost starts creeping dangerously close to the current price, you're likely adding too aggressively or far too late in the move. Always maintain a healthy protective gap between your weighted entry cost and the prevailing market valuation consistently. You must stop adding capital to the position immediately and without question when the asset becomes obviously overbought or exhibits extreme dangerous price volatility. These conditions almost always precede sharp, violent, corrective reversals that can quickly erase months of hard-earned systematic profit. Recognizing precisely when the market enthusiasm reaches undeniable mania levels is a crucial speculative skill that must be mastered. Wait patiently for the next confirmed trend phase to begin. Never purchase into the fever pitch of market excitement. Pyramiding up your position size or adding to a winning trade is a highly strategic and mathematically sound speculative tactic that works consistently. Pyramiding down, however, by adding capital on dips to falsely lower your average price is pure, unadulterated investment idiocy. One strategy relies entirely on demonstrated strength and confirmed evidence. The other relies strictly on pure hope and stubborn resistance to reality. Never confuse aggressive winning scaling with desperate losing averaging down tactics in your execution. We must now discuss the single most dangerous and fatal error commonly committed by amateur speculators, the practice of averaging down prices. This ruinous habit reflects a fundamental refusal to instantly accept when the initial directional analysis was simply incorrect in its timing. It is a slow, agonizing method of turning very small, easily manageable mistakes into massive, capital-destroying trading failures persistently. A truly disciplined speculator immediately cuts losses quickly. He absolutely never attempts to rescue a demonstrably failing trade. Averaging down is literally the act of throwing perfectly good, uncommitted capital after demonstrably bad committed capital reserves. You are deliberately allocating fresh resources solely to defend a mistake the powerful market has already clearly judged unfavorably and rejected. This highly destructive practice violates the most cardinal rule of only adding to positions that are actively proving profitable and strong. Never use fresh capital solely to prop up the corpse of a fundamentally flawed and failing speculation. Averaging down unambiguously signals a reliance on intangible hope over concrete market evidence and confirmed market reality in decision-making. Hope is not a viable or reliable strategy in the brutally efficient speculative markets, and it certainly will never pay your bills. The market only responds to undeniable capital flow and verified momentum, completely ignoring your internal desire for financial recovery. Base every single trading decision purely on observable facts, rigorously rejecting all emotional wishes entirely from your process. The market has conclusively and definitively proven you wrong if the trade necessitates averaging down tactics instantly for survival. You must immediately and unequivocally respect the sanctity of the calculated stop-loss order placed at the point of thesis invalidation. Accepting a small calculated loss is the defining professional action that consistently preserves necessary psychological balance and capital. Do not waste energy arguing with the market's judgment. Simply admit your mistake and move swiftly to analyze the next viable opportunity. If your first tiny test trade is clearly proven wrong by immediate sustained adverse movement, you must exit the entire position and instantly restart your comprehensive analysis. Do not linger near the scene of the failure, seeking spurious false reasons to remain wrongly engaged in the losing effort. A fresh, detached perspective, derived from new tape reading, is absolutely essential for accurate and profitable future entries. Preserve your essential capital by walking decisively away from losing propositions instantly and entirely without remorse or regret. Always maintain ample, readily available cash reserves that are kept ready and waiting for major, undeniable market opportunities when they finally arise. Only dry powder allows you the critical flexibility to fully capitalize on confirmed shifts and substantial, verified breakout movements. Never tie up all your available liquidity in uncertain, underperforming, or speculative positions prematurely before confirmation. Cash is a powerful speculative tool, granting you the critical freedom of strategic action at all times. You strategically need ample cash readily available for capturing the next confirmed, massive swing in the overall market direction. When the market moves decisively and strongly, those speculators who hold cash dictate the terms of engagement and subsequent profit accumulation. Ensure your portfolio allocation always heavily prioritizes available liquidity over the necessity of being fully invested at all times, which is foolish. Wait patiently for the perfect pitch that you know you can hit decisively, utilizing your deep cash reserves only then. Never, ever, under any circumstances, allow your accrued substantial paper profits to regress completely and turn into significant, actual capital losses. Once a position is substantially profitable, you must immediately move your defensive stop to protect at least a significant portion of the gain. Failing to protect achieved profits is simple trading negligence that unnecessarily costs otherwise capable speculators enormous fortunes over time. Protect what the market has generously provided you through constant, careful risk management execution. Use highly specific mental stops first to guide your instantaneous decision-making processes regarding any reversal in the expected entry direction. Then, immediately reinforce these crucial internal limits with hard physical stop orders placed directly with your broker for absolute security assurance. Hard stops protect you comprehensively against unforeseen extreme volatility, communication failures, and emotional hesitation during any rapid market decline. A disciplined speculator never trades without both clear mental boundaries and physical protection stops in place strategically. Finding the necessary patience to successfully hold a winning position through its inevitable minor market gyrations is often significantly harder than decisively cutting a definitive loser. Amateurs consistently sell their winning positions far too early due to an overriding fear that the profits might disappear entirely in a heartbeat. True, successful speculation requires holding strong conviction through minor volatility swings once the major trend direction is fully established and confirmed. Let the substantial profits run their natural course. Manage the embedded risk strictly, but never prematurely choke the potential growth. Reviewing this successful system, you must start incredibly small with your initial testing block consistently and without exception. You only scale up your overall position size when the market trend is strongly and repeatedly confirmed by both accurate price and confirming volume action. Adherence to these strict steps minimizes early capital risk exposure, while simultaneously maximizing your participation in the established, highly profitable flow. This is the only method for successfully building truly substantial positions without introducing unnecessary, crippling risk exposure. Remember this central, unwavering truth. Massive speculative positions absolutely require massive, sustained confirmation steps before full capital deployment is warranted. Never leap into a major position based simply on gut speculation, unfounded rumor, or mere personal opinion alone. The precise size of your position must be directly proportional to the clarity and confirmed velocity of the underlying trend observed in the tape. Always respect the monumental risk inherent in size, demanding constant, undeniable proof from the ticker tape's action. True, lasting speculation demands complete, absolute control over your volatile emotions and an absolute mechanical adherence to a defined set of trading rules. If you cannot diligently follow your own established plan perfectly, you frankly have no business being active in the market at all. The discipline applied strategically to the position-building process ultimately defines the dividing line between lasting speculative success and inevitable financial failure every time. Be a relentless machine of execution, never a slave to desperate hope or paralyzing panic. Master the inherent nuances of this precise pyramiding system, and the boundless fortune available in the speculative market will eventually be entirely yours to control. This established strategy is historically time-tested and based accurately on predictable human behavior reacting to price movements, which fundamentally never changes. Apply it diligently every single day, observing the ticker tape with cold, detached, rigorous analysis consistently and without wavering. Success in the competitive world of speculation is reserved only for those few who execute discipline flawlessly. To truly understand the mind of the man who mastered these principles, to witness the epic market battles where this very plan was put to the ultimate test, the essential chronicle remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. This is not merely a book, it is a deep psychological portrait of a master at work, a narrative that gives life and context to every one of these timeless rules. For those committed to this study, a link to the edition featuring a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, is provided in the description below.